All right, people. So, welcome to Jumbo IS and welcome to this lecture series called Economic Survey. Now, if you have been following this lecture series, you know we are on to chapter number 3 of Economic Survey. And chapter number 3 is titled Monetary Management and Financial Intermediation. Basically, simply put, money and banking. Now, when we talk about money, we are basically dealing with RBI because RBI is known as the monetary authority of the country. Okay, it issues the rupee notes. And plus, it also manages money supply. Now, when we talk about financial intermediation, it is basically banking sector or NBFCs, non-banking financial companies. But financial intermediation is basically taking money from someone and then lending that money. The job that banks do. Now, this entire sector is known as or is a constituent of financial sector. Okay, financial sector is the sector that deals with money. Now, financial sector for any economy is the bedrock of that economy. If your financial sector is healthy, well, your economy is doing fine. But if your financial sector is troubled, your economy is in the doldrums. Now, if we are focusing on Indian economy, we should definitely talk about its financial sector, its financial health, as they use this term. So, in this chapter, basically, we will talk about RBI's policies towards money management, money supply, increasing money supply, reducing money supply, and we'll also talk about the health of banking sector. And since insurance sector and pension sector are also part of financial sector, okay, so banks, NBFCs, and insurance and pensions, they are all constituents of financial sector. Since insurance and pension are also constituents of financial sector, we'll also talk about them in the end. Okay, so this topic is very important because it deals with the overall health of Indian economy because it talks about financial sector. Okay, now this topic is going to be fairly easy but a little bit technical, so please pay close attention. All right, then, without further introduction, let's straight away jump into this chapter. All right then. So the title of this chapter is Monetary Management and Financial Intermediation, short for or long form of Money and Banking. Monetary management means managing money supply, and financial intermediation is basically banking only. Okay, banking and NBFCs, those who are in the business of lending money. Now, the theme of this chapter is, as I've mentioned before, that most of the times economic survey focuses on the positive aspects of Indian economy. So this chapter is going to be no different. All right. So what is the theme of this chapter? Refining the regulatory touch from resilience to renaissance. Renaissance means a very good change, right, in the positive direction. So Indian financial sector is undergoing renaissance. Okay, it showcased resilience during the troubled times of pandemic, but now it is showcasing a renaissance. I mean, there is a new boom in India's financial sector, and the prime job of regulating financial sector is with RBI. Prime job. Though SEBI also does the job of regulating stock markets, IRDA regulates insurance markets, PFRDA, Pension Fund Regulatory and Development Authority, regulates pensions. But prominently, it's the job of the RBI. Okay. Now it is saying, the theme is saying that earlier these regulators had a very high-handed approach. What do you mean by high-handed approach? Basically, the regulation was too much. There were too many rules and regulations. But now we are reducing those rules and regulations. The regulatory touch is refined so that the minimum amount of regulation that is required is there so that nobody hijacks the system, okay, or takes unfair advantage of the system. Okay, so there is minimum regulation, but the regulation should not be too much so that it hampers ease of doing business, right? So we have to do this delicate balance. This is what we mean by refining. And this chapter basically presents the evidence that we have refined our financial sector. And this chapter, like the previous chapter, also gives us a comparison of India with the rest of the world. Where the rest of the world is struggling, India is not struggling that much. Okay, so refining regulatory touch so that ease of doing business is there, rules are not too much. From resilience, because our financial sector, banking sector showcased resilience during pandemic lockdowns, to renaissance, a new boom, a new horizon is there in our financial sector. This is what the economic survey says. Okay, now what is there to prove that we are undergoing renaissance? So let's talk about this. Okay, all right. So India's financial sector is acting as a strategic buffer in a volatile global economy. We all know that the global economy is going through uncertainties. And what are those uncertainties? Well, first of all, wars, and then Trump's tariffs. This is causing too much uncertainty. Okay, but in these uncertain times, well, while the entire world is struggling, India's economy is acting as a strategic buffer, or India's financial sector is acting as a strategic buffer. We have enough resources, or we have enough finances to basically take care of this uncertainty. Okay. There is domestic resilience in India's financial sector. Global markets grapple with US tariffs and geopolitical fragmentation. What do you mean by geopolitical fragmentation? Well, people have taken sides. Countries have taken sides. There are wars going on, right? While India's domestic health remains robust. Then, RBI has also made a policy pivot. Now, what is that policy pivot? With respect to money supply or monetary policy. Now, there are three routes for monetary policy. Number one, accommodative, which means increasing money supply, because your economy is struggling, so you increase money supply. Okay, basically when the economy is not doing well, then accommodative monetary policy is applied. Okay, accommodative monetary policy increases money supply, and therefore the economy gets enough liquidity to basically go through a recession, okay, or survive a recession. Then there is another policy that is called tight. This happens when the economy is doing fairly well, but there is too much money in the economy. This too much money in the economy is causing inflation. Now, RBI wants to control inflation, especially, well, it is RBI's mandate to keep inflation between this window, right? So when there is too much inflation, then RBI reduces money supply by following tight money policy. And then there is neutral, neither increase nor decrease. So earlier, when the economy was not doing well, RBI consistently followed an accommodative policy stance. But now RBI has shifted its stance to neutral. Basically, what is RBI signaling through this? RBI is saying that we are not that much worried about economic growth. Economy is doing fine. There is enough liquidity. And yes, we are not that much worried about inflation, but we need to be mindful of inflation. Though RBI clearly says we are not that worried about inflation. Therefore, we are neither going in the direction of accommodative nor going in the direction of tight. We are in the neutral territory. That means things are going well. Okay. Then another good thing, another good thing or evidence of good thing is the solution to the problem of twin balance sheet syndrome. Now, what is twin balance sheet syndrome? Pay close attention. Okay, very briefly. India has solved this problem of twin balance sheet syndrome. So there are corporates, right? And these corporates borrow money from banks, right? Now imagine there is a very bad economic situation, so the balance sheets of corporates is in the doldrums, is declining. Now these corporates have taken money from banks. If they are not earning money, how will they return their money back to banks? This money back to banks. So if corporates' balance sheets are challenged, well, they won't be able to pay back the money. They would become NPAs. And when they become NPAs, the balance sheet of banks are also challenged. Okay. This problem is known as twin balance sheet syndrome. Okay, twin balance sheet syndrome means the balance sheet of corporates is challenged, the balance sheet of financial companies, banks, NBFCs, they are also challenged. In such a situation, the economy is in a very bad situation because banks are so much focused on reducing their NPAs that they are not generating new credit. They're not providing new loans because they're already focused on their old bad loans. And when credit creation in an economy declines, the economy declines. Its growth rate declines. So this problem has been solved. Banks' balance sheets are at their all-time high, very good. Corporates' balance sheets are also doing well. Okay, so this is the current situation. Make sense? So this is one good evidence. Then, global uncertainty persists, but investment strategies diverge by firm size. Okay, so there is global uncertainty. Yes, there is global uncertainty. What are the global shocks? First of all, US tariffs, and then AI is booming and it is destroying many traditional businesses. It is creating a ruckus. So these are global shocks. Market reaction, rise in credit spreads. What is credit spreads? Basically interest rates. Interest rates have risen. Because of rising interest rates, cost of capital has increased globally. Means loans are becoming expensive, credit is becoming expensive. Now, because credit is becoming expensive, money is a little dry. Well, depending on the size of the company, their investment strategies are changing. So if there is a big company which has huge pools of cash, large deep pockets, they are going on a investment drive. Okay, they are pretty agile. Mid-sized companies, well, they are saving money. And vulnerable companies are the small-sized companies which are lacking cash, lacking capital. And their capital expenditure, well, they have held on to that. They are not investing that much. So if we talk about private investment is mostly driven by large companies. This is the reason. And the reason is global uncertainty. Because of global uncertainty, interest rates have risen. That means loans are becoming expensive. Credit is not that cheap. Because credit is not that cheap, not many companies are borrowing. And because they're not borrowing, they're not investing. Make simple sense? Okay. All right, then let's move forward. Now let's talk about RBI's monetary policy. So remember, whenever there is low GDP growth, okay, RBI follows accommodative monetary policy. Now, accommodative monetary policy, increasing money supply, boosts growth. Why? Because it flushes the economy with liquidity, more money. So it boosts the economy. Okay. But there is one downside to this. Okay. And that is inflation. Yes, it will boost the economy. Extra liquidity boosts the economy, but it also causes inflation. Increasing money supply is inflationary in nature. Now, RBI has to make a choice whether it should focus more on growth or on inflation. Okay. Now, if your economy is really struggling, RBI says, do hell with inflation. We'll deal with it later. Let's focus on growth and follow accommodative monetary policy. If the economy is fine, okay, then RBI follows tight money policy. And tight when the economy is doing fine, but inflation is a big problem. So if economy is doing fine, inflation is a big problem. To reduce inflation, you follow tight. Okay. And when we talk about neutral means we are trying to balance high growth with low inflation. Okay. So that is why we are in the neutral territory. We are neither boosting liquidity and creating inflation, nor reducing liquidity and reducing inflation. No, we are in the neutral territory. And RBI has recently shifted its monetary policy stance to neutral. And plus, it says that inflation is already in the low territory, plus there is enough liquidity in the system. As you can see, inflation is very low. Okay. And RBI increases or decreasing money supply by repo rate. Reduce repo rate, accommodative. Increase repo rate, tight. Keep it neutral, neutral. Make sense? Okay. All right. Now, let's talk about financial intermediation or banking sector. You remember we talked about twin balance sheet syndrome? Yes? Now, in twin balance sheet syndrome, we were particularly concerned about banks. And banks were facing two problems. Okay? What were those two problems? Number one, they had poor assets or NPAs. And number two, they had low capital and high NPAs. This really made them struggle. Now, this was a problem. This was a decade-long problem, but this was solved. Now, their NPAs are at an all-time low, multi-decadal low. For 2-3 decades, NPAs have never been this low. And their capital adequacy ratio has also increased. So this problem has been solved for now, of course. But economic survey says that this is a good sign. Banks are full with capital and their NPAs have also declined. That means their health, banking sector health, is good. And whenever banking sector health is good, well, the economy breathes easily. Yes? Okay. All right. Next, credit flow shifts. Now, banks are healthy. Financial market is healthy. Now, credit flow has increased. Credit has increased. Okay. But this economic survey actually points out towards a pattern. When it comes to large corporations, large companies, well, they are not borrowing money from banks. They are mostly choosing the route of corporate bonds. They are issuing bonds. Okay, and then borrowing money. I hope you're familiar with bonds. Okay, if not, do ask your doubts. And small companies are still reliant on banks. Now, this is a good sign. I'll tell you why. Because earlier, large companies used to borrow so much money that banks were left with little money to lend to small players. So small players were crowded out. Okay, and this was not a good sign for inclusive growth. Okay, large players were having access to all the savings in the banks. But now, large companies are using the corporate bond route. because of which banks now have enough money to fund small companies. So this is a good example of inclusive growth. It has freed up the resources of banks to lend to smaller companies, freeing up banks' balance sheets for aspirational sectors, small companies. Good sign again. Okay, the structure of credit flow has also improved. Make sense? Okay, next. And yes, why are banks so ready to lend to smaller sectors? Well, remember one thing: banks lend money to borrowers. Yes, they do. Okay, and when banks lend money, they also charge an interest rate. Yes, but before lending you money, banks basically check your profile, whether you're a worthy borrower or not, whether you will take the money and return it back or not. Now, to check your worthiness, well, that is checked through your credit worthiness or your credit score, credit rating. Okay. Now, if your credit score is good, banks are readily available to give you money. And they give you money at lower interest rate because your credit score is good. But if your credit score is bad, banks are reluctant to lend money to you. Okay. And even if they do, they will charge a very high interest rate. Simple. This is the simple, in very brief, I have told you the dynamics or the basically the rationale that banks follow before lending money. Clear? And the thing is that if banks have a very good way of judging your credit worthiness, they feel very comfortable in lending money to you. Now, with the help of technology, banks have so many avenues to know your credit worthiness. For example, PM Swanidhi scheme has increased credit access to small players like street hawkers, rickshaw pullers, all these people. So this is good. Okay. Borrowers graduate to large loans. Basically, it says that small borrowers have now started asking for more large loans, which means banks are also comfortable to give them large loans. Why? Because their credit worthiness is easily known now. How is it known? Because of UPI, there is a transaction history, your transaction history. Banks judge take a look at your transaction history and see whether this person is having money or not. Okay. Plus, PM Jan Dhan Yojana also, everyone has a bank account. So digital public infrastructure has aided banks in judging a person's or a company's credit worthiness. Technology has come to the rescue. All right. Okay. Next. And this is Insolvency and Bankruptcy Code, IBC. So basically, this economic survey is giving us a mixed picture of Insolvency and Bankruptcy Code. Okay. What is bankruptcy? We all know when a company goes bankrupt, the bankruptcy case needs to be resolved. Now, earlier, before Insolvency and Bankruptcy Code, the resolution process used to take a lot of time and it never got resolved. Because of IBC, banks are able to easily recover their money from bankrupt companies. Okay, so resolution has increased, recovery rate has increased to 30%, resolution to liquidation ratio improved to 91%. That rather than liquidating an entire company, so if a company has gone bankrupt, banks generally go the route of liquidation, which means they sell everything that this company owns and then take that money to resolve their NPA issue. Okay, but now banks are moving towards more and more towards resolution, that the bad debt is resolved, NPA is resolved. So this is a good sign. Behavioral shift also, firms paying before insolvency to retain control. So IBC has improved recovery of money by banks from bankrupt entities. But there is only one problem. And remember, I told you it's a mixed picture. The IBC envisioned that the entire bankruptcy case would be resolved in max to max 330 days. But average time is 713 days. There are still delays. This is one problem that is yet to be solved. But overall, a good picture of Insolvency and Bankruptcy Code. Banks are able to resolve their NPAs using this IBC. That is why their NPAs have gone to a multi-decadal low. Okay, so it's a good reform. IBC was launched, many of you must know this, in 2016. Okay, next. Now, very short things. Okay, retail revolution. This, I guess, you all are familiar with. Many households have become from savers, or they have transitioned from being savers to investors. You must have seen these apps, Zerodha, Grow. Many people have opened their demat accounts and have started investing in stock markets. Everyone is now interested in stock market investment. And most people are investing in mutual funds, all these areas, right? Mutual funds, SIPs. So now normal households have turned to being an investor. This is very good because in India's stock market, earlier the share of foreign institutional investors was large. Now the share of domestic Indian institutional investors, Indian mutual funds, Indian insurance funds, it has increased. Earlier, FIIs had a higher ownership in India's stock market. Now DIIs have. What are DIIs? These mutual funds or these other funds in which you invest, who invest in stock market. Yes, so more and more people are going towards mutual funds and all these, and some people are directly investing in stock market using Grow app, Zerodha and all. Good sign. Indians households are transitioning from being normal savers, doing an FD in a bank, fixed deposit, to investors in multiple assets. Okay. Yes, there is one bad news. Banks are becoming healthy. NBFCs are becoming healthy. Okay. But there is one way to borrow money apart from banks and NBFCs, and that is by issuing corporate bonds. Now, corporate bond market in India is still not deep, not that great. Only large corporates are issuing corporate bonds. So corporate bond market remains the missing pillar of Indian finance. If we take a look at other countries, so corporate bond market share as a percentage of GDP for South Korea is 79%, Malaysia 54%, China 38%, in India it's 16%. And why is that? Because only large corporates issue bonds. And the evidence of this fact comes from this, that 90% of the corporate bonds issued are AAA rated. That means high rated. And who issues high rated bonds? Large corporates. So small or mid-sized companies are still going the traditional banking route. Plus, borrowing money through corporate bonds is still expensive. How expensive? When you borrow money from corporate bonds, the average interest rate is 7.61%, which is still expensive. Okay, still a lot. So this is the issue. That is why mid and small sized companies are not going this route. Make sense? Yes, this we are not going to spend that much time, though it is given in your notes. Gift City, basically inviting foreign capital. Gift City is in Gujarat. So it is a very good initiative to invite foreign capital into India. So all of this is there. Then pension sector, we are seeing growth in pension sector. There are some challenges. Pension assets are only 17% of the GDP. Well, while for OECD countries, it is 80%. But we have taken many reforms like unified pension scheme and many others. So pension market will become more deep. And pension market should become deep because India's population is also aging a little, though it's still a lot of youth. I mean, as a percentage of population, still elderly, the share of elderly population is rising, and who these elderly people are dependent on pensions. So we need to fast track the penetration of pension market in India. So this is one thing, a note of caution given by economic survey. And then there is insurance sector. Well, a lot of details are given in your notes. Okay. For example, India's goal is insurance for all by 2047. Health insurance is now the most dominant sector in all the insurance schemes. Okay. Penetration has stagnated, but government has taken many reforms. For example, Sabka Bima Act allowing 100% FDI. Now foreign insurance companies can come to India and sell insurance. All of this is good news. Okay. Because now foreign companies would be competing with domestic companies, more competition. And whenever there is competition between companies, well, the prices come down. Consumers stand to benefit. Okay. So this is the thing. Regulatory philosophy, the one I talked about earlier. Okay. We are basically using technology, AI, and we are refining our regulatory touch. So these are some details about this. And this table is very important. Not a table, but a graphic. Remember this will be given in your notes. Financing Vikasit Bharat, the architecture for 2047. So basically, government's vision for financial sector stands on 3 pillars. Okay. First, good regulation. So firm on stability, that we will regulate enough. Rules are going to be there so that there is no misuse of the system. But they are not going to be that much that it stifles innovation. It stops innovation. Okay. So regulation is going to be refined. Innovation, we are going to use AI for financial sector, for insurance sector, for banking sector. This would improve efficiency and diversify. Deepen bond and insurance market. And when we say deepen, means multiple products, multiple types of insurances, multiple types of companies, more insurance products, all of that. So these are the 3 pillars of taking India into the dream of Vikasit Bharat. And India cannot become Vikasit Bharat if it's not economically advanced. and it won't be economically advanced if it does not have a top-notch financial sector. So that's the message of this chapter. All right? Okay. That would be all. With that, we conclude today's session. So thank you so much for watching, everyone, and I'm sure it has added value to your preparation. But revise the notes, memorize the notes, and ask your doubts in the WhatsApp groups. All right then. With that, I shall conclude today's session. Thank you so much for watching, everyone, and I shall see you next time with another chapter in this lecture series called Economic Survey. Thank you, everyone.